Hello, this is your host John Thornhill, and you're listening to Startup Europe, the Sifted Podcast. Joining me today in London is Anu Adebajo, former Atomico partner and, as of February this year, CEO of the Newton Venture Programme. Launched in 2020 by VC firm Phoenix Court and London Business School, the educational programme aims to train new generations of VC talent, whether they are experienced investors or simply exploring new career paths. Anu has a great overview of the VC industry. She began her career in Sheffield, where she grew up. In 2012, she joined a fund and later went into the British Business Bank. After nearly 5 years, she moved to the LP side, where she personally deployed more than £365 million into funds before moving to Atomico, where she led its fund-of-funds strategy. We'll get into how all this experience led her to the Newton Venture Programme, as well as why Europe's venture industry might need to reinvent itself. Anu, great to have you on the podcast.
Thank you for having me.
You've had several different roles in the VC industry, as an investor, an LP, and now as someone who oversees the training of the next generation of VCs. Which role has been the most interesting and fun?
That's a hard question. How can I answer anything other than what I'm doing now? But, I think it all links. If I think about the thread of what I like, it's about nurturing talent. So whether that is as an LP, being there for the GPs that I invest in, helping them think about how to build out their firm, or whether it's now at Newton and really being there to build this next generation of VC talent, it's that same element that threads through it. And so, I can't pick one specific role, but it's the what I'm doing within the roles that it excites me the most.
But you enjoyed all of them.
Yes.
Before we get into the Newton programme, let's chat about some of the hats you've worn. First of all, what attracted you to your first fund?
Yeah. So I knew that I wanted to be in venture capital. Probably one of the few people that deliberately chose to be in VC, and many get into it by accident. I was looking for venture funds to join. I was at one point in Lagos in Nigeria, and I was looking there. There were no funds at that time, VC funds. There were private equity funds, of course, but no VC funds. So when I moved back to Sheffield after a short stint, about 18 months in Lagos, I was looking for funds nationally. So I assumed I might be going to London, but I happened to see this role, and it was in a VC fund in Sheffield, which is very, very unusual. So the opportunity to still be in my local area, to be in a venture fund, to be in a fund that at the time was backed by public money. So I knew that it had a continued source of capital, which is obviously a huge problem for many VC funds. And that was very attractive to me. But also, it was a very high volume fund. So we co-invested alongside angel syndicates, and we were taking 2 or 3 companies to IC every single week. So by the time that I left that fund, we maybe had done 70 or 80 companies. So getting to see the breadth of talent in terms of founder talent and companies in the UK was really exciting to me. We backed companies like Gusto, like eBury, for example, companies that have touched all facets of public life. I guess that's really was interesting to me. So that was the attraction there.
And the financial returns were good?
I mean, I left before, venture's a long game. So I was there for 5 years. So the track record, I can't speak to what the overall track record of the fund is, but as I said, there were definitely some, unicorns within that portfolio. Absolutely.
Why did you move to the LP side?
Yeah, I think there are 2 reasons. Very transparently, one was thinking about what's next for me individually. How can I progress within a kind of a team and a structure and an organization? There weren't really opportunities there. That's the reality, and I think that's something that is very familiar to lots of people, junior in VC firms. Kind of what does succession and promotion look like? The other aspect of it really was also I wanted the opportunity to diligence a load of funds in the ecosystem to think
of a way of doing it.
Absolutely, to say, do I want to join them? So I went and I moved to the LP side. Also, the team on that side were fantastic as well within the British Business Bank. I really admired them, especially led by Ian Connerty, kind of a really, really great investor. But it was an opportunity for me to to diligence the funds that I thought I might want to go and work for. Spoiler alert, I didn't want to work for any of them by the time I'd done the diligence. But it was a great opportunity to, again, see this huge volume of funds across the UK and European ecosystem, where you wouldn't get that anywhere else just because of the volume of capital that the British Business Bank has to deploy.
You say you didn't want to work for any of them, but you did join Atomico.
Yes, and actually Atomico was one of the funds that we invested in, that I actually invested in. I think that, again, the common theme here is well capitalized, having a solid platform that I can leverage to see everything. That's, I think, really, again, another thread of my career. And so, Atomico, $5 billion of assets under management. They had invested in, several, like 60 or so pre-seed seed funds, and were looking at doing this in a way that was not just strategic or opportunistic, but much more of a kind of programmatic way of investing in funds, early stage, which is what I really liked. And actually at British Business Bank, British Patient Capital, we've moved more towards doing growth funds and more towards doing later stage funds. And so the opportunity to go back to the early stage emerging managers that I really, really enjoy working with, again, as part of this kind of nurturing the talent and being part of the journey of individuals and of firms, was really attractive to me. So yes, I did find a firm that I wanted to work with, and was there for a year building out a fund of fund strategy. Ultimately, in the end, everything was rolled back. So all of the non kind of core direct investments were rolled back, and so we didn't go forward with doing the fund anymore.
The fund of funds is a bit of a mysterious corner of the VC world. Can you explain to us what it is and what you achieved at Atomico while you were running it?
Yeah, so fund of funds is effectively a fund that you raise from LPs to invest in other venture capital funds. That's it in a nutshell. And obviously that differs from an institutional LP, which is not raising money from any other LP. So you're operating as a fund, but instead of investing into companies, you're investing into other venture capital funds. We didn't invest in, well, we had some investments that we had committed to that we followed through on whilst I was there. But really for me, it was about going through the process of designing a fund of funds that I thought the ecosystem needed, that I thought would provide the strongest returns, that I felt was kind of innovative and was doing something a bit different to others. So thinking about what the portfolio construction would be, thinking about, would we be an LP that follows funds into every single fund that they do, follows firms into every single fund they do, or will we really be focused on their first and second funds, where if you look at the data, that tends to be, emerging managers tend to perform better. At the same time, actually, when you look at the worst performing funds, they can also be emerging managers too. So it is an interesting spread. But yeah, the opportunity to do that, to have a blank sheet of paper and say, build the best fund of funds, that to me is an incredible opportunity that you just don't ever get, unless you're doing it yourself.
And the power law suggests that you only really want to be invested in the top decile of
Absolutely.
venture firms. So how do you ensure that you get into those?
Yeah, and so I think this comes down to selection. And if you think about, you either go two routes. So some LPs go down the route of saying, we are just going to get access to the names that we know are the best. So they might be the indexes, the Excels, the like the bulletins, etc. Or if you're going down the emerging manager route, you say, I believe that I, as an investor, as an LP, know how to select from emerging managers the best managers. And I think that's the route that we were going down, that I was going down. That's the route that I was trained to do during my time at British Business Bank and British Patient Capital. And so that's that. And so there's lots of ways that you figure that out. There are some things you can look at which are really kind of clear. Is there a track record of some kind? If you're an emerging manager, it might not be a fund. It might be because you might be spinning out and doing something else. It could be operational track record. It could be angel track record. We've got funds who, that's, if I think about something like Kindred, for example, they started because they were angel investing and seeing each other crop up in the same investments time and time again, and said, hey, you're doing investments that I like and we have a similar mindset here, let's come together and build a fund. It will be the team. So who are the team? What's their background? What's their experience? What's their dynamic like together? Do you think that they are, a strong and stable team, but also as individuals, do you think they're great, selectors of companies? It'll be the strategy as well, of course. Like, is the strategy timely? Is it something that makes sense for where the market is at the moment, or where the manager believes the market is going? Does the amount that they're raising make sense, again, for the strategy that they're trying to do? So there's loads of, I guess, some of those kind of concrete things you can look at. And then there are just some intangibles that you hone over time as an investor, that you can just kind of, you kind of sense and you pick out, and you can kind of see whether it's the X factor, whatever it is you want to call it, but you kind of start to get a sense of, this investor or this team has got something special here, and I think that they're going to be able to deliver something great. So it's all of that together.
Who was the most impressive VC you met during that time?
I don't like to name names. This is like choosing a favourite child. There are a few, and actually, what the interesting thing is, it's not always, often they're quite polarizing people. Often they're the ones who others will say, I could never work with this person, I don't like them. And now I've said that, I'll definitely not be saying the names. But for me, often, those people are like that because they are, they have to be very singular. They have their motivation, and all they can see is that. And that sometimes does mean that, some of the other softer skills get lost, I would say. Some people might be coming to mind for people that are listening to this, but yeah, there are a lot. I have lots of favorites, and actually, the reality of it is, I'm still in contact with most of the funds that I've committed to, and those relationships that kind of last even now when I'm not actively investing in any funds. So yeah, lots of favorites.
Why did you leave Atomico?
I think it's as I said, the kind of core. Direct investments were the focus, and so anything that was not core,
right? And that actually got hived off, didn't it, to PE Group Klein Hill Partner?
Yeah, I think they ended up, after I left, kind of selling down some of the fund investments.
Right. What did you do next?
What I did next was take what is being called apparently an adult gap year, and just took time out to really reflect and think about what I wanted to do next. As I said, I deliberately entered the VC world. It wasn't an accident. But after 11 or 12 years, I wanted to make sure that I was being intentional about what I was doing next. So I took time out to talk to lots of people about what they were doing. I took time out to also just do nothing, to do nothing work related, right? To do lots of fun things, I think I did a LinkedIn post where I said I'd done like over 100 Reformer Pilates classes in a year. I took time out to really explore London. I took time out to read and, travel and all those types of things. And to make sure that I was intentional about what I was going to do next. Interestingly enough, though, you can kind of have an idea of what you think you're going to do, and then you end up doing something else. So I think I really was sure that I wanted to stay in the LP world. As I said, I love doing that. I love being part of fund managers' journeys, and I feel like I've been very, I say me and the team that I've worked with, especially at British Patient Capital, there are franchises that would not exist, and I mean good franchises, not the ones who maybe should not exist anymore, but good ones who would not be in operation if it wasn't for us. Other LPs didn't see the vision, were not prepared to take the risk. So that's I thought that was what I was going to do. But I didn't end up doing that. I ended up joining Newton as CEO.
We shall come to that shortly. What do you think LPs want from VCs right now? I mean, it's quite a tumultuous world, isn't it? But yeah. What are LPs looking for when they're choosing a VC?
DPI. I think in a nutshell, DPI, right? I think that's top of mind for lots of LPs at the moment. It's a really interesting time to be an LP. I've been talking to lots of my kind of LP contacts over the last few weeks and months, and the landscape has changed from when I was actively investing. We used to have lots of institutional LPs who were making big commitments. You'd see several names crop up time and time again, and I would see them around the table at the LPACs, at the AGMs. Most of those firms are no longer operational. The LP side of the business the team have gone on else to somewhere else. They're not making commitments anymore. So where LPs are present, I think they are really having to justify making commitments into venture, and that is partly because we haven't been seeing the returns in Europe that LPs were expecting. We know why some of that is kind of the public markets, basically not being operational effectively, especially for tech companies, valuations being all over the place, and realizations not tracking from kind of where rounds have been holding company valuations at. And so LPs are really looking for the funds that can demonstrate that they've been able to give DPI to their investors, have been able to be, and that's not just about saying kind of have they been able to find exit routes for their companies. It's have they as funds been able to find exit routes for themselves? Have they been smart and intentional in how they've maybe sold down their stakes as the rounds have progressed? And I always say that a lot of people get into venture because they think they have a great network or they can spot fantastic companies. But I will often say to people, well, why don't you just be an angel? Really, you are doing those things. You're being an investor, but you're also being a fund manager. And there are skills as a fund manager that you need to be able to know how to do. One of those is thinking about how do you release value as rounds progress, and thinking about the actual mechanics and technicalities of being an investor.
And a lot of institutional funds will say this is a very opaque, difficult world to invest in. Is the fund of funds strategy quite a good way to get into this if you're not an expert in this area?
I think so, but I think you have to be careful about who you're backing. Absolutely, many investors use fund of funds as a way to test out, to dip their toe into the venture world, to deploy capital through somebody else, and then be able to double down maybe on things like co-invest, or be able to use that as a learning opportunity to potentially do it themselves later on. But as I said, you've got to be very intentional about which team you are backing. Is it a team that knows what they're doing, that has expertise, that has a kind of clear process and has some kind of track record in being able to invest in great funds? And again, I go back to, it doesn't mean necessarily just great existing funds, but great, the future great funds, the emerging managers. Not everybody's able to do that, but yes, I think it is a good strategy. I understand though that fund of funds can be tricky for investors. It's the fees, that's the real thing, and I also understand why that is, because in this current way that we are doing venture in Europe, in the UK, it is very fee driven because returns aren't there. So you're not seeing the performance, but you are seeing funds either raise larger and larger funds, collecting fees, not giving much in return. So I can see that the fee sensitivity is a kind of very valid concern in an ecosystem where everybody is just delivering and providing returns and providing performance. You don't care about the fee. But that's just not what we have. So I understand why they're very focused on that. That's what's making it quite challenging for the pension funds, for example. And they're thinking about how can they get comfortable, with the way that fees work in venture, and it's a tricky one.
You're not ordinary. No 9 to 5, meal deal lunches, meetings about meetings, compulsory team building, living for the weekend. You're made for more, for the extraordinary, and you need an extraordinary bank. HSBC Innovation Banking exists exclusively to help visionary VC-backed tech and life science businesses achieve their ambitions. From pre-seed to IPO and beyond, we provide custom solutions co-created by actual industry experts to help you scale, delivered by a dedicated team you can call whenever you need to. Find out why 4 in 10 UK unicorns have chosen us at hsbcinnovationbanking.co.uk.
Right, let's turn to the Newton Venture Programme. What's it all about?
Yeah, so Newton, historically, as you said, we have been focused on education and kind of training the next generation of VCs. I joined Newton as CEO in January of this year, and my mandate was very clear to take us into our next iteration and to really focus on the strategy kind of going forward. So how I see Newton is it's a place where the next venture leaders are built. That's what it is in a nutshell. How we do that is through a variety of ways. Historically, that's been through our education programs and kind of training that talent. Going back to some of the things I've said about the technical nature of VC that often gets lost, that's something that we absolutely do because we don't have, it's not you don't just turn up and go to a panel of VCs who are talking about their experiences. It's a curriculum that's been designed in collaboration with London Business School. We have lecturers from London Business School, from Imperial, from Oxford, from other institutions who are there really taking our cohorts through the technical side of VC. And then there's the kind of additional application where they'll hear from top VCs about how they apply this in their in kind of their work. So that's kind of part of what we do. I like to say that we have the best network in venture. We have 800 alumni right now. It will be this time next year, it'll be 1,000. They're global. So it's from all over the world. So you can really tap into, again, top kind of talent and top individuals from all over the world. And actually, that's not just for the alumni to do that with each other. It's also for VCs as well to be able to tap into. So again, we've got the best VC talent from all over the world. We often get VCs reaching out to us to say, we are hiring for specific roles. We are not advertising this role. Can you send us your best, whatever from
How many students go through your program every year?
So every year, it depends on the program. So we have the fellowship, which is in person, and that takes place over several months, but it's 3 modules, 3 days each in person, split out over the year. That's a cohort of about 30. And then we have the fundamentals, which is online, and that takes place right now twice a year. We're looking at doing that more, and that tends to be about 65. So that we'll repeat that twice a year. So that's why kind of we're growing fast each year, and then we're thinking about additional things we can do. We're currently working on something for emerging managers. You can see that I've said that really resonates with me, and it's something I'm interested in. We have seen investors come up through. So the fellowship is kind of more early mid-career, but we get participants who are thinking about or working on their own fund. And so it's an opportunity there for them to work through that. We do something called the Fellows Vision Statement, which looks at kind of what is the change you want to see in the ecosystem? How do you want to contribute to that? And for many, that is a fund. And so they think through and kind of work through what might that look like. So they can use the fellowship as a way to kind of figure out their thesis. And so we're thinking about how can we actually really support them in that next phase, those who are right at the beginning of that journey, and giving them all the kind of tools that they need, again, lots of the technical skills and the kind of other practical pieces to be able to build out fun.
One of the big differences between the kind of US VC scene and the European one is that in the US, generally speaking, a lot of the big VCs are run by former founders, whereas in Europe, it tends to be more kind of former bankers or financiers or whatever. Do operators make the best VCs?
I think anybody can make number one. I always the word best when it's used in anything to do with venture, I always find really interesting because I always think, what does best actually mean? And I think for me, best is who actually provides performance, right? Who actually provides value. And I think that can be anybody, and that's kind of a Newton philosophy, right? We think like the best talent can come from anywhere. So I've seen it all, but actually I think with the next generation, you are getting less of that kind of profile who have come through the traditional financial channels. You're getting kind of investors who have come from all over and from all walks of life, who've come from financial, who've come from operational, who've come from none of those things and come from more the arts or something else, and have transitioned into venture. So I think that this new generation is coming with a different angle, which I think will also provide some really interesting kind of returns and performance and funds and innovation.
How competitive is it? How many people apply? How do you get in?
Yeah, so it is competitive. We have hundreds and hundreds of people that apply, and we go through a process to really I guess, shape and design the cohort, right? We want it to be useful for those who are on the programs, and also we want to have a really good mix of people. We also want people who are going to really be kind of present and participate and, kind of show high interest. And I think that's really important, and it's going to be increasingly important as we think about one of the future strands of our strategy, which is, as I said, if we believe, which we do, that we have the best VC talent coming through Newton, then one of the next logical steps is to actually back that talent with capital. And so, as I mentioned, we have this Fellows Vision Statement, which effectively is, could be seen as somebody's fund thesis. We want to be able to back that with capital to allow them to go and test the thesis, to allow them to go and build track record. So we're currently in talks with parties about putting what I'm calling the Newton Fellows Fund together, and that would be amazing to be able to do that. But that's why we have to be kind of selective in the cohorts, because we want to make sure that we are selecting for top talent. But the interesting thing is, we see that when we select for excellence, naturally diversity follows. So if I think about the makeup of our cohorts across all programs, we have over 80% from overlooked backgrounds. And that's not because we're selecting for them. We're selecting, as I said, for ambition, for ability, talent, for engagement, for values, for all of those other things. And naturally, that falls out of it.
How far advanced are your talks to create a fund?
We're getting there. I would say watch this space. In an ideal world, this time next year, for the next cohort, I would love to be able to do this. And I think it could be really exciting because, going away, building a track record, making some investments, coming back, sharing that with the cohort, sharing that with the wider kind of Newton ecosystem, friends of Newton. For me, I would love to see outcomes which are either, which actually have happened. So, we've had, as I said, people who've built funds off the back of their time at Newton, and they've seen LP investment come from from other alumni, from their cohort. So I'd love to see that happening, see funds being invested in off the back of this. Also, though, I can imagine a scenario where a VC is in the audience is hearing someone talk about the deals they've made in this time period and say, we love what you're doing, it resonates with us, come and join us, we'd love to hire you. And I'd love to see others saying, I love what you're doing, it's very similar to what I'm doing, let's join together and do a fund. So, that would be ideal. As like this time next year, it would be great to have this in place. Let's watch this space.
Okay. You wrote a LinkedIn post recently talking about your experience at Newton, and you say, I've seen what happens when ambitious, bright people are given the right foundation. They don't just grow as investors, they change what the industry looks like. And that's exactly what you're talking about,
Absolutely.
isn't it? This is a way of kind of addressing the kind of shocking lack of diversity in the industry.
Yeah, and I think it's not just the diversity for diversity's sake. I was talking to an LP that I've known for a very long time yesterday, and we were actually saying it's quite worrying how we are kind of reverting back to a lot of the same, just the sameness, right? That we've seen, that I saw in venture in 2012. We don't seem to be making that much progress. We're recreating some of the old boys club type of mentality in a new boys club mentality. Again, I'm sure people can think of some of the people that I'm thinking of where, we're kind of replicating those same dynamics, and it's quite worrying. And for me, it's worrying because not even just because of saying there should be space for all sorts of people in venture, but worrying because I think it means that we're actually leaving money on the table. I think we're not taking enough risk, which we should be. Venture should be about risk. I think we're not actually being innovative enough, because if everybody is the same, they often are thinking the same. We see this all the time, and everybody piling into the same deals. People are still doing that, right? And this is back to what I was saying about what's best. What does best mean? Best, everybody thinks that lots of people will say best is this one specific thing, and they all follow and pile into that. That to me is really worrying. We should be taking more risk in venture. We should be trying to be innovative. We should be looking at things in a different way, trying to find talent from all over the place, trying to be different from what other people are doing, trying to say all of these investors are looking over here, I'm looking over here because I really believe that this is where the true value is going to be found, and I don't believe that I can extract value by going into the same thing that everybody else is with valuations that are being driven up and up and up. That is just not what seems to be happening, and I don't really understand why. I do understand why, because I think it's actually really hard to truly be somebody that is actually contrarian, or truly be somebody that is actually a risk taker. I think it's much easier and much safer to just do what everybody else is doing. And actually, I don't know in Europe that we are really being incentivized, back to the point as I was also making about fees versus carry and all of those things. I don't think we've felt the pain points yet of what happens when you consistently don't perform.
But from what you're saying, you think the whole model needs to be reinvented, or in other words, it might have to return to what it was originally.
Yeah.
This kind of risk-taking,
Yeah,
extreme approach.
Absolutely. And I think I also do wonder whether is the venture model, does it still work now for the types of companies that we have? Was it really made for a time where there was a big gap of lack of capital for companies, full stop, especially companies that were kind of more innovative, that were doing something that was kind of seen as very, very risky. I think now true risk in companies it's hard to. I think that there are more avenues for companies to get capital, even companies that are perceived as risky than they used to be. So I think it's just the dynamics of venture, to me, seem to have changed slightly, but the model is being used in the same way, and I'm not sure whether that is actually the right approach. And the thing is, though, I will hold my hand up and say I don't know what is the right approach, but it feels to me that we're continuing to get stuck in this loop of not actually producing some companies that obviously are have gone on to exit for large numbers and to provide great returns for their investors, but several more that don't, and several funds that also are not performing. And so I think there's maybe something fundamentally in the way that we've been doing this kind of venture GPLP model, fixed term structures that are 10 plus 1 plus 1, all of that. I think maybe there's something different that needs to be looked at.
From what you're saying, it sounds like we're heading for a day of reckoning for quite a lot of these funds.
I hope so, but I actually don't know. I really thought in post 2021, they were. So if you think back to what happened in the kind of crazy times of COVID, lots of funds actually got started. Lots of people raised funds. I was really worried at the time. It seemed like any principal that had maybe been on like one or two half decent deals could claim attribution to those deals, was being encouraged to go and start their own fund, and actually were often able to raise that fund. Most of them, many of them, have not been able to go and raise fund two. And so I felt that there was going to be a reckoning 2023, 2024, that we would see, many funds not be able to raise, many kind of franchises stop, and also not just new ones, but even existing ones. I had a few that I'd earmarked that I was very sure would not be able to raise again, and that would be the end of them. But that's not happened at all. There's been a couple who've their framings that they've chosen to not go out and raise again. But actually, I have seen many funds continue on, kind of be zombied and kind of go on to rebrand, even like change the whole team, where actually I think they should have just stopped. And we haven't seen that. And I think we unfortunately do need to see it. And it feels like it should be coming, but I'm not sure whether Europe can be that ruthless. I think we're not in that I don't like to do the comparisons to the US because I think we're different, but I think that's one area where I do compare, right? Where actually there's no consolation prize for non-performance in the US. You're up or you're out. Here, we kind of keep drip feeding a lot of these, non-performing funds.
So we should go time on the zombie funds, you think?
I think so. I think it's healthy for the ecosystem. I think it's going to unlock a lot of things. It will unlock the LP capital. If the LP capital starts to see, okay, what ends up remaining are the good funds. I think that helps to just clear the path and unmuddy the waters.
You say that you don't like comparing Europe to the US. I do. One of the striking features at the moment in the US is this concentration of VC money into a very small number of companies. So, between them, OpenAI, Anthropic, XAI, and Waymo have raised about 188 billion, and that's actually before the latest Anthropic fundraise. That accounts for about 65% of all VC investment globally. And the bottom half of US startups by valuation attracted only 7% of all investment. So as you're saying, the nature of the VC industry is changing enormously. Are we seeing the same trend in Europe, do you think?
We're seeing a little bit of that. Obviously, the numbers are different, but we are still seeing that. And I question, especially in kind of UK and Europe context, some of this I question, is this kind of follower capital versus a reflection on kind of the true value, kind of best will remain to be seen. We'll see what happens in terms of, kind of acquisitions, exits. Like that's the proof is in the exit. The proof is always in the exit. We can get really excited about large valuations. I've seen several companies in my underlying portfolios who were unicorns and then, kind of faded to nothing, either through listing and kind of tanking there or, kind of just not having an exit route. So let's see. But yeah, similar trends, absolutely. We are seeing that kind of concentration.
So you've got a lot of very bright students coming through your program. You've just described a lot of the big challenges facing the VC industry. What is a VC firm of the future going to look like, do you think?
Yeah, I am seeing a kind of bifurcation at the moment. So you're going on one side with these large mega funds that's probably where lots of the established players are trying to go. I think for many of them, they have grown their kind of platform, their team, their kind of offering to such an extent that to keep all of that going, they need to go into that kind of mega fund territory. They've got maybe several funds under their belts, which have got varying performance. And so again, the large fund fees pay to cover through some of that in lieu of kind of any significant carry. That's on one side. I'm not, 100%. I know that we need capital in Europe that can invest in growth stage, companies. That is absolutely true. So, to the extent that that's what some of those funds are doing, I completely understand that. But again, I think from an LP perspective, you've just got to understand some of the dynamics about kind of, is this a fee grab versus, are they actually going to be able to successfully deliver their strategy and get into companies that are going to actually deliver. On the other side, you've got solo GPs, kind of emerging managers, small funds, kind of sub 10, 15 million. And I'm seeing a lot of those now. I'm seeing managers say, look, because of the fundraising environment, for many of them the fundraising environment was so tricky, I'm going to focus on this kind of smaller fund size and really do something different here. If you're a solo GP, act almost more like an angel, act almost more like a kind of additional co-founder for the founders you're investing in, be much more high touch, be this kind of trusted partner, be really kind of on the ground and, active to source these companies. That's what I'm seeing on that side too. So I think that's a really, really interesting model. Obviously, from a kind of just a pure mathematical standpoint, it makes it easier to return the funds. But again, from a mathematical standpoint, it makes it harder for you to cover your cost. If you're a 10 million fund, and you're charging 2% fee, that's really tricky. I'm seeing that's something that the kind of funds are struggling with. But yeah, I'm seeing that's kind of the way things are going. So obviously the part that I'm interested in is that more emerging manager, kind of maybe smaller fund. It might still, if so, I'm very open to somebody making the kind of middle of the road 50 million, whatever, or sub 100 million fund work. But I'm really seeing a lot of the innovation happening where investors are having to be kind of scrappy and do a lot with a little. And I was talking to a manager yesterday who was, thinking about how they've almost deployed their first fund. They're raising another small fund too, solo GP, but have hired a community person and are thinking about raising basically sponsorship for all of their kind of platform work, so that then they don't have to use the money from the fund. So this is the innovation that happens when you've got to be scrappy. And I think that's really interesting for an LP, because you can say, actually, you're putting all of this into investing, but you're also thinking about how can I continue to add value. And this is a deep tech fund as well, so very specific kind of community and network that can add value. So I like hearing about things like that.
And do your students prefer to go down the scrappy route, or do they want to join a fee machine?
I will say that it's probably a mix, right? I'm kind of appreciate the irony of kind of me saying that through my career I've liked going to places that have a platform that so of course everybody likes to be somewhere where there is a platform, where there's capital, and I think there's that's fine for those who want to do that. But also our kind of the Newton Alarm are global, and there's differences in the way that venture is in. If you're in somewhere like Africa, venture is scrappy because it just is still very nascent as an asset class, right? Compared to PE, which is much more established, and you have much more of these kind of bigger firms. The VC funds there are, whatever size they're still scrappy, right? They don't have the kind of luxury of this kind of massive fee base over several fund cycles. So I think there is a mix, but for many of them, I think they just want to discover the next top companies, the next highest value, highest exit companies, which make a difference in the lives of the world. That's what they really want to do. They want to be part of discovering that, whatever route that they need to take to get there.
Oh, I'm going to be very interested to see all these brilliant new ideas coming out of the venture program at Newton. Finally, we have a few quick fire questions. Okay. Imagine you no longer worked in venture and all industries had Newton programs. Which one would you join?
Do you know what? I've always thought I'd make a good private detective.
Well, that would be an interesting business model. What underappreciated skill should you look for when hiring?
I think emotional intelligence. Do you want to expand?
Yes, I do.
Okay.
How common is that in the VC industry?
Exactly. And I think that. So I've often seen dynamics where you have one GP maybe who is low on the EQ, and then they balance it out with others who are a bit higher. I was going to say I resonate with those who have high EQ, but actually, again, some of my favourites are probably people who don't really have that. But again, they are self-aware and they surround themselves with those who aren't. I think like venture is a people business ultimately, right? It's an investment business, but you're doing that via your connections with people.
And how do you test for EQ?
Yeah, it's a tricky one. You just have to spend time with people. You talk to them. You kind of get a sense of, the more they talk, the more they kind of reveal themselves. But the referencing is like key. That has always been the part for me that's been the most important. That's surfaced a lot, and I kind of recently have written an article where I was talking about the kind of importance of weaker links and looser networks. And actually, for me, it's been just as important for investments that I don't make, because things have been surfaced through the referencing, and some of that has been as a result of a kind of lower EQ.
Finally, you're a bit of a bookworm, I believe. Yes. What's the best book recommendation you can make to Sifted listeners? So
I controversially do not really like nonfiction. I think because of this being in this world, when I'm reading purely for pleasure. So the book that I love the most is called Chain Gang All Stars. If you like Hunger Games, but you like more realism with a bit of a kind of social justice twist, it can be a hard read, but very, very well written, very in some ways entertaining. So yeah, really recommend that.
Realistic Hunger Games, I've got to check that one. Anu, we're out of time. Thank you so much for joining us on the show.
Thank you for having me.
We'll drop a link to the Newton Venture programme, as well as Sifted's daily newsletter, in the episode description. We'll also put a link to my recent article on reinventing VC. Do get in touch with your thoughts. As always, please rate, review and share the podcast. And this episode was produced by Maya Dalrymple Hornby.